So, is QuantumScape a revolutionary solid-state battery pioneer poised for this massive breakout? Or is it, just a classic value trap catching overly optimistic retail traders in a relentless falling trend?
Oh man, it is the ultimate market Rorschach test right now. I mean,
Well,
you look at the latest news, the charts, the underlying technology, and you kind of just see exactly what your current portfolio bias dictates.
exactly.
Some analysts are flashing strong buy signals and calling it insanely undervalued, while others are pointing to clear sell signals and a really brutal downward trend. It's an incredibly polarizing stock.
Which honestly makes it the perfect target for us today. So welcome to the deep dive, everyone. Let me just set the scene for you real quick.
Yeah, let's get into it.
Today is April 17th, 2026. QuantumScape, ticker symbol QS for those following along. They closed yesterday at $7.04.
Yeah.
But if you watch the tape this morning, it's showing some real pre-market and after-hours strength. It's hovering around $7.13 right now.
Yeah, and if you zoom out just a little bit, this stock has actually surged over 13% in just the last 2 weeks alone.
Which is wild.
It is, and it's barreling toward this massive Q1 2026 earnings report coming up next week on April 22. That upcoming earnings call is really the catalyst driving all this recent volatility.
Absolutely. So our goal today is to tear down the financials, look at the quarterly and annual income statements, the balance sheet, the cash flow.
Right, the whole fundamental picture.
Exactly. And we're also going to analyze the technicals, discuss the trend direction, the momentum, and really just weigh this fierce bull versus bear debate surrounding this entirely pre-revenue company.
We really need to look past the hype and figure out what the market is actually pricing in right now.
Totally. And hey, if you're enjoying the breakdown so far, please like the video and subscribe to our YouTube channel. And it is absolutely compulsory that you leave your feedback in the comments. Let us know if you're buying or selling.
We read all of them. And just to be super clear up front, as we dig into these numbers and debate the risks, this is just a natural analytical exploration of the data. We're just looking at the mechanics driving the stock.
Yes, definitely not financial advice.
Right, no financial advice here. Please do your own due diligence before making any moves.
Always. So, to figure out if a stock is a trap or a treasure, I feel like the logical first step is to look at the immediate price action. What is the technical pulse actually telling us?
Well, context is absolutely everything here, because the technical landscape for QuantumScape right now is just a complete study in conflicting timeframes.
How so?
So that 13% run-up you mentioned, that is real momentum. It puts QS in a short-term bullish trend.
Okay.
And this is but if you step back and look at the medium to long-term view, the stock remains distinctly bearish. The 52-week high and low paints a highly volatile, frankly painful picture for long-term holders.
Well, yeah, the 52-week range is rough.
It really is. We've seen a high of $19.07 all the way down to a brutal low of just $3.60.
Man, that is a staggering drop from the highs. So if I'm a retail trader looking at the chart today trying to figure out if this short-term strength has actual legs, what are the key battlegrounds? Like, where's the floor and where's the ceiling?
Right, so key support the floor where buyers have recently proven they're willing to step in and, try to catch the falling knife that currently sits at $6.41.
Got it. $6.41.
Yeah. And on the upside, your immediate resistance is at $7.59, which was a recent localized high. But the real boss level resistance is way up at $10.42.
Let me guess, that's the 200-day moving average.
Exactly. That's the 200-day. And until it breaks and holds above that line, most institutional algorithms are just going to view any rally as a temporary bounce within a much larger downtrend.
Okay, I actually want to challenge this whole idea of momentum for a second here.
Sure.
Saying a stock is up 13% is great, but it doesn't tell us that the engine is about to overheat, right?
Yeah.
Let's unpack the indicators. What is the RSI actually signaling today?
Okay, so the Relative Strength Index, or RSI, it's currently sitting at 59.78.
Which is pretty neutral, right?
Neutral to maybe slightly bullish. Typically, a stock is considered overbought and, due for a pullback when the RSI crosses above 70.
Right.
So purely mechanically speaking, there is definitely room for the stock to run before it triggers those automated sell signals.
But the MACD paints a much muddier picture, doesn't it?
It does, yeah. The MACD is basically showing a lot of chop right now. Depending on your exact time frame, it's reading anywhere from negative 0.30, which is inherently bearish, to positive 0.09.
That is all over the place.
It really is. That chop just reflects the sheer volatility of the last few weeks. The market is seriously struggling to pick a definitive trend direction. Though one tangible positive for the bulls is that the stock is now trading comfortably above its 50-day moving average, which is at $7.01.
Okay, look, looking at all these technical metrics, I really can't help but view this stock like a rubber band.
A rubber band? How so?
Well, it was stretched so far down toward that $3.60 low,
Yeah.
right? That represents absolute maximum tension on the downside. Sellers were totally exhausted.
Oh, I see where you're going.
Yeah, so this recent 13% pop above the 50-day moving average, it might not be a structural recovery at all. I think it might just be a mechanical snapback. Just a reaction to being stretched way too far, rather than any real change in the company's long-term trajectory.
Honestly, that is a highly probable reading of the chart. A technical bounce is fundamentally different from a structural recovery.
Exactly.
And that forces us to look past just the charts and the latest news. Momentum is really just human psychology and algorithmic programming plotted on a graph. To know if this is a real recovery, we have to ask what investors are actually buying when they purchase a share of QuantumScape right now.
Which means looking under the hood at the financial reality. And I gotta say, the financial reality is quite stark. Let's look at the income statement. The annual revenue is zero.
Yep, zero.
They are a totally pre-revenue company. I mean, they're just now starting their first very small billings, but for all analytical intents and purposes, it's zero.
It's essentially zero, yeah.
And alongside that zero revenue, they posted a massive net loss of $435.05 million for the full year of 2025. And their Q4 2025 earnings per share was a negative 17 cents.
I will add a little nuance to that negative 17 cents, though it actually perfectly matched analysts' expectations.
Oh, really?
Yeah, the market knew QuantumScape was burning cash, and they
Yeah.
burned exactly as much as Wall Street modeled they would. So there were no nasty negative signals or surprises there.
Okay, fair enough.
But the much more fascinating dynamic is their balance sheet and the cash flow. The cash burn is undeniably massive. We are looking at negative $242.5 million in operating cash flow for FY 2025
Wow.
and a trailing 12-month free cash flow of negative $278.75 million.
That is literally over $250 million flying out the door every single year just to keep the lights on and the research going.
It is, and this is where it gets interesting, despite that crazy burn, their balance sheet is remarkably well capitalized right now.
Wait, how is that possible with no revenue?
Well, they ended 2025 with $970.8 million in total liquidity. If you look at their Q4 2025 sheet, they hold $1.31 billion in total assets against only $139.18 million in total liabilities.
Hold on, let me make sure I'm understanding this. Only $139 million in liabilities against over $1 billion in assets. Are they not taking on massive loans to fund all this research?
They actually aren't. Their debt-to-equity ratio is a phenomenally low 6.07%. They have very minimal long-term debt. They are equity financed, not debt-burdened.
Okay, wow. That completely changes the analogy I was forming in my head. I initially thought of them as like a brilliant medical student living on giant loans, just hoping their future surgeon salary pays off the debt.
Right, the classic startup story.
Yeah, but if they're equity financed, that means they aren't borrowing money. They are selling off pieces of themselves to raise that cash.
Exactly.
It's like a medical student who, instead of taking out a loan, agrees to sell 5% of their future lifelong earnings to an investor every single year just to pay for tuition. They have no debt, but by the time they graduate, they barely own any of their own career.
That is a much more accurate representation of how equity financing works here. To survive the medical school of advanced battery development, they have repeatedly diluted their ownership pool.
And that leads us to a huge discrepancy that I really want to tear into. If the balance sheet has nearly $1 billion in liquidity to survive the next couple of years, why are the people closest to the company seemingly rushing to the exits?
Ah, yes, the insider selling.
Let's talk about the history of who is buying and selling, and the short sellers too, because the order flow here paints a rather alarming picture.
The insider activity is definitely providing a lot of ammunition for the bears right now. Over the last 24 months, key insiders have sold $148.18 million in stock.
I mean, I know insider selling happens for mundane reasons, right? Paying taxes on vested options, buying real estate, basic portfolio diversification.
It happens all the time.
But nearly $150 million is a whole lot of diversification for a company that hasn't even brought a commercial product to market yet.
It is. And it's the timing of the recent sales that really has the market talking and generating some negative signals. In early April 2026, literally just weeks Before this crucial April 22 Q1 earnings report, both the chief financial officer and the chief technology officer executed stock sales.
And they sold those shares at prices between $6.18 and $6.36. This is where I strongly push back on the entire bull thesis.
Let's hear it.
If I'm a retail investor, I'm looking at this and thinking, if this solid-state battery technology is truly on the verge of a revolutionary breakthrough that will change the whole EV landscape, why are the CFO and the CTO taking chips off the table at $6 a share?
It's a fair question.
That is a fraction of their $19 52-week high. Why wouldn't they hold if they know the tech is about to pop?
It's a totally valid concern regarding asymmetric information. The idea that insiders know more about the internal struggles than the public does.
Exactly.
Now, to be completely objective, these were planned fails. They were likely executed under 10b5-1 trading plans.
Okay, what exactly does that mean for the average investor watching this happen?
So a 10b5-1 plan allows major insiders to schedule their stock sales months or sometimes even years in advance.
Oh, I see.
Yeah, they dictate a specific date or a formula for selling, which legally blinds them to the current stock price. It shields them from accusations of insider trading based on, non-public information. So the CFO and CTO didn't wake up in April and panic sell. This was decided a long time ago.
I understand the legal mechanism there, but man, the optics are still terrible.
Oh, absolutely.
Even if it's scheduled, having a massive sell-off right before earnings while the stock is hovering near 52-week lows, that acts like a heavy wet blanket on retail optimism.
It certainly doesn't help sentiment.
And it's not just the insiders dumping shares. The short sellers are circling this thing aggressively.
They are. The short interest on QuantumScape is sky high. It's currently sitting at roughly 20% of the float.
Let's define float really quickly for anyone who isn't staring at financial terminals all day.
Sure. The float simply refers to the number of shares actually available for public trading. It subtracts all the closely held shares owned by insiders, founders, or restricted stock.
Right.
So when we say 20% short interest, it means 1 in every 5 available shares on the open market has been borrowed by a trader and sold short with the explicit bet that the price is going to fall further.
And how does that specific dynamic play out for the stock's day-to-day movement?
It basically creates a volatile pressure cooker. Heavy institutional shorting causes relentless downside pressure. This is exactly why retail traders often get trapped in a stock like this.
Because every time it tries to rally, the shorts just hammer it back down.
Exactly. Every time the stock tries to rally on a small piece of good news, short sellers pile in, borrow more shares, and sell them to push the price back down.
But there is a flip side to that pressure cooker, right?
Yeah.
This is the exact setup required for a massive short squeeze. Let's walk through the mechanics of that.
A short squeeze is the ultimate upside risk for those bearish traders. Because short sellers borrow shares to sell, they eventually have to buy them back to return them to the lender.
Right. They don't own the shares.
Exactly. So if that April 22 earnings report brings any unexpectedly massive positive news, say a manufacturing breakthrough or a new major automaker partnership, the stock price will spike.
And then the shorts start bleeding money.
Yep. The traders who shorted the stock start losing money rapidly. To stop their losses, they are literally forced to buy back the shares at the current market price.
And that sudden influx of forced buying drives the price even higher.
Exactly, which triggers more short sellers to hit their pain threshold, forcing them to buy, creating this violent upward feedback loop.
So that 20% short interest is essentially a mountain of dry tinder just waiting for a spark.
Precisely.
Which brings us to the ultimate debate. We know the technicals are choppy. We know the financials require massive cash burn. We know the shorts are betting heavily against it. So what is the actual fundamental reality here?
That is the million-dollar question.
Is QuantumScape an undervalued innovator or a pre-revenue value trap? Let's start with the best-case recovery scenario. What is the fundamental bull case here?
Well, the bulls are betting on the technology itself, which, if successful, is a total paradigm shift. QuantumScape has successfully demonstrated their QSC5 solid-state cells on Ducati race bikes.
Let's pause and explain why a solid-state battery is considered the holy grail compared to what we use right now. Traditional lithium-ion batteries, the ones in our phones, and current EVs, they use a liquid electrolyte to move energy back and forth.
Right. And that liquid is heavy, it's highly flammable, and it degrades over time. QuantumScape's innovation is replacing that liquid with a proprietary solid ceramic separator.
Which changes everything.
It does. A true solid-state battery offers drastically higher energy density, meaning a lot more range in a smaller, lighter package. It has much faster charging times, and it is vastly safer because it literally won't catch fire if punctured.
And testing this on a Ducati race bike is a brilliant proving ground. Race bikes demand incredibly high discharge rates and super lightweight profiles.
Exactly. If your battery survives the extreme demands of a Ducati on a track, the core chemistry works.
So the science project phase is largely validated. But, science projects don't generate revenue. How are they turning this into a business?
That's where the transition to the Eagle Line comes in. The Eagle Line is their high-volume production prototype facility. The Bulls argue that QS is currently crossing the chasm from being a research lab to becoming an actual industrial manufacturer.
Okay.
Furthermore, the real crown jewel of their bull case is their strategic licensing agreement with Volkswagen's battery company, PowerCo.
Oh, that deal is massive. Volkswagen has insanely deep pockets and a built-in global customer base. That agreement essentially guarantees QuantumScape a cash runway all the way through 2029.
It really does. It removes the immediate existential threat of bankruptcy that plagues most pre-revenue startups.
So if you zoom out, the bulls see a company with the cash to survive, a partnership with one of the world's largest automakers, and a technology that could literally render current EV batteries obsolete.
Yep. And that optimism is reflected in some of the wild divergences we see in analyst valuations and ratings.
The valuation gap here is one of the craziest I've ever seen. The general consensus rating across Wall Street analysts is just a hold, with an average price target of $7.97.
Yeah.
That is barely above where it's trading today.
But then you look at the discounted cash flow models.
Right.
DCF models attempt to figure out the value of an investment today based on projections of how much cash it will generate in the future. Some of these models projecting QuantumScape's potential out to 2030 suggest the intrinsic value of this company is actually $44.59 per share.
So if you're a retail investor looking at a $44 price target, you're probably wondering why the stock is sitting at $7. That is the undervalued innovator thesis in a nutshell. If they capture even a fraction of the global EV battery market by 2030, a $7 share price today is the bargain of the century.
Absolutely. But we have to be objective and look at the downside risks too, because the bears look at that exact same data and see a completely different narrative. They see the worst case continuation lower.
Let's hear the bear case then.
Let's start with the valuation metric. Bearish analysts point out that even at these depressed single-digit prices, QuantumScape is still trading at 7 times its projected 2028 price-to-sales ratio.
Let's translate that for you listening. A price-to-sales ratio compares a company's stock price to its revenues. A ratio of 7 is expensive even for a company generating massive sales today. But paying a 7x premium for sales that might theoretically happen in 2028?
It requires a lot of faith.
It really does.
It assumes execution is totally flawless, and in advanced manufacturing, execution is rarely flawless. Let's talk about the real-world structural risks first, and arguably most damaging to the retail investor: ongoing stock dilution.
Oh, this is huge.
Since 2021, QuantumScape's share count has skyrocketed from 233 million shares to over 558 million shares.
I want to underline this because dilution is the silent killer of retail portfolios. Going back to our earlier analogy about selling pieces of the pie, if you bought a slice of QuantumScape in 2021, your slice has essentially been cut in half.
Right.
Not because the pie got smaller, but because the company issued twice as many slices to new investors to raise that $970 million in liquidity we were praising earlier. That cash wasn't magic. It was bought and paid for by diluting the original shareholders.
Precisely. And what are they using that cash for? They're trying to solve a monumental technical hurdle. Making one perfect ceramic separator in a controlled lab is one thing. Scaling up the Eagle Line to manufacture millions of them flawlessly at incredible speeds without microfractures.
That's an entirely different beast.
It is. The scrap rates and quality control issues at that kind of scale can bankrupt a company.
And while they're burning cash trying to figure out how to mass produce this ceramic separator, the competition isn't just sitting still. Traditional lithium-ion batteries are getting cheaper and more efficient every single year. The goalposts for what makes a better battery keep moving further away.
Which connects to perhaps the most existential macro risk of all, the shifting broader automotive industry. The initial euphoric projections for full EV adoption by 2030. They've been significantly pushed back across the board.
Yeah, we're seeing that everywhere. Automakers, including QuantumScape's key partner, Volkswagen, are visibly pivoting back toward traditional internal combustion engines and hybrid vehicles.
Exactly. If the global market decides that hybrids are the most practical bridge technology for the next 20 years, the total addressable market for a hyper-advanced, premium, solid-state EV battery shrinks dramatically.
Right. You don't need a revolutionary solid-state battery for a hybrid car that only goes 40 miles on electric power before the gas engine kicks in.
Exactly. The bears argue that QuantumScape might finally perfect their technology right as the market decides it doesn't really want to pay a premium for it anymore.
Man, that is a sobering thought. So, synthesizing everything we've unpacked today, the moving averages, the billion-dollar balance sheet, the insider sales, the short squeeze potential, and the massive technical scaling challenges, what is the definitive outlook here?
Well, in the short term, QuantumScape is a highly volatile momentum play. Its immediate short-term outlook rests entirely on the April 22 earnings report.
It's going to be a huge day.
It is. If they announce a delay in the Eagle line, that 20% short interest will completely hammer the stock. But if they announce a breakthrough or a new customer, those same shorts could trigger a violent squeeze upward. It is a total powder keg.
And what about the long term, looking out to 2028 and beyond?
In the long term, it is a binary bet. It goes back to our medical student analogy. They either solve the technical scaling of the Eagle line, utilize that Volkswagen cash runway effectively, and become a titan of the next generation battery industry, or they struggle with manufacturing, burn through their remaining liquidity, continually dilute their shareholders just to survive, and ultimately get outpaced by cheaper, evolving lithium-ion alternative.
Which honestly makes it one of the most fascinating high-stakes battlegrounds on the market today. Just a final reminder to you listening. This deep dive is an exploration of the data, the arguments, and the market mechanics. Always do your own research and consult with a professional before making any moves in your own portfolio.
Right. Knowledge is most valuable when it's understood and applied critically. The market will tell us who is right soon enough.
It certainly will. And if you found this analysis helpful, please take a second to like the video, subscribe to our YouTube channel, and leave your thoughts in the comments section below. Your feedback and engagement are what allow us to keep digging into these companies. We want to know if you think the April 22 earnings will trigger a squeeze or a complete collapse.
It's definitely going to be a pivotal week for the EV sector.
It really is. And I want to leave you with one final provocative thought to mull over as you watch the tape this week. We talked about the mechanics of the battery and the shifting goalposts, but consider this. If QuantumScape's solid-state battery truly is the holy grail of the EV world, the ultimate promised solution to range anxiety and charge times, why is the broader automotive industry suddenly hedging its bets and retreating back to the safety of gas-powered hybrids right as this technology is supposedly crossing the finish line?
A very telling question worth considering.
Thanks for joining us on the Deep Dive. We'll see you next time.